Hello, everybody. This is Chuck Carnevale, co-founder of Fast Graphs, the fundamentals analyzer software tool. Many of you know me as Mr. Valuation because often, most of my videos and even articles that I publish are talking about the importance of valuation and how important it is. But, valuation is relative also to the growth rate of the companies in question. And I think this is something that people don't always understand. Just because you buy a stock at a good value doesn't mean you're going to make a lot of money. It really depends on what kind of stock you're buying and what its opportunities were. Now, I originally had planned on doing this particular video today on IBM and American Telephone because these are both, I'll call them low growth or even no growth investments that I've made in the past. And I've written about them and talked about them. And I get a lot of comments, a lot of questions, even perhaps criticism, referring to them as value traps, etc. So I was going to cover both of those because one of the things I think that gets overlooked with comments like that is you have to always ask yourself, what are you investing for? People invest in CDs, they invest in annuities, they invest in bonds, obviously. There's all types of different investments that people invest in, real estate, of course, and then, of course, common stocks. But as I often say, it's a market of stocks, not a stock market. Just because you use the word stocks doesn't mean that they're all the same. They're actually quite different. They have different characteristics, different objectives, different capabilities. So one of the questions that I think always needs to be answered or at least thought about when you're having these kind of discussions are, what are you investing for? What is your goal? What is your objective? And how realistic are you being when you're making those decisions? So I'm going to kind of go over my logic of why I invested at AT&T. And of course, AT&T is what I'm going to talk about today because AT&T is obviously in the news after the big announcements they've made. And it's even being referred to as a dividend cut, which I don't quite see it that way, and I'll try to explain. Now, I'm not going to get into a lot of details about the transaction because there are numerous places that you can go to get that kind of information. For example, this is the Wall Street Journal here, and you can see there's numerous articles on this AT&T quote-unquote merger with Discovery, where they're going to be spinning off their Time Warner product and merge it, and then the shareholders are going to get current AT&T shareholders are going to get 71% of this new entity when it happens. Probably, by the way, about a year away. Now, there will be AT&T referred to it, I believe, as a dividend reset. Many people are calling it a dividend cut. I think that's accurate, but yet inaccurate at the same time. And again, I'll cover why. But I'm not going to get into the heavy details about the deal. Again, you can see there are numerous articles here on AT&T. There's a really good article in Barron's Magazine that was listed there, and talking about AT&T cutting its dividend and spinning off Warner Media. And here's how much its stock might be worth. And they actually give you some numbers in here, and I'll let you all go ahead and read this article for yourself. But the bottom line is, I want you to realize that AT&T is going to be a different business after this transaction occurs. And so they're going to reset their dividend, but they're also going to be spinning off a pretty valuable asset to the current existing shareholders. And that also needs to be taken into consideration, which I'll get to in a moment. Now, I went on the site Seeking Alpha here, and you can see AT&T stock is down, 2% today. But, these are some of the articles here that were written on the stock, just in the last couple of days. And you can see that, first of all, the vast majority of them are bullish to very bullish. There's a couple that are neutral. All right. So has this been a value trap, or what was it all about? And I'm going to cover that more as I get into AT&T itself. But the point is, there's a lot of discussion about AT&T and what's happening. So let's go ahead and get into the stock here, and I'm going to go ahead and show you AT&T, and I'm going to use the new version of Fast Graphs to do this here. What I want to start out with is I want to point out a couple of things about AT&T in the first place. Number one, from approximately here back, this is Southwestern Bell Communications. It's not AT&T. They bought AT&T, as you all know it. As I like to say, this is not your grandfather's AT&T. At least it hasn't been, but they've kept the iconic brand name, the Ma Bell AT&T. It was actually a landline company to a great extent when they bought it, and the thing is morphed. But the point I want to make about that is, when I consider AT&T today, I look at AT&T in this configuration. This is the AT&T. Approximately, I'm about a year past it since Southwest Bell Communication actually bought the company. Now, here's the point I want to make. This is a very slow growth company. Average growth here is about 3.16%. And you can see there's even been some negative years, and the growth going forward is not expected to be very high. This is all pre this announcement. Okay, so this is the AT&T as it existed. All right, now I purchased AT&T, and this is going to be very close. My actual cost basis was $29.87. So this is going to be about as close as I can get, but it's going to allow me to do some interesting mathematics here for you. All right, I bought this stock under no illusion that this was going to be a mega, capital gain producer for me. I bought this strictly for the dividend income, and I was using it as part of a portfolio construction strategy that allowed me to get a dividend yield that was required. I was looking for in excess of a 3% dividend yield on average over the portfolio. And at the time, when I was looking at AT&T, the dividend yield was 5.72%. I want to make sure you see that clearly. Let me get that out of the way. So the dividend yield as of December 31st, 2011 was 5.72%. Now, I was expecting very little growth over the period of time. And frankly, for the next 4 or 5 years or so, the stock performed really well. I even had a positive rate of return. I was making about 11% a year, which was a bonus at that time. But I want to remind you again, I was investing in AT&T for the dividend. I wasn't interested in capital appreciation. Now, subsequent to that, we've had 2 or 3 really bad years of price action, but we've had steady, consistent, growing dividend, albeit at a very low rate. But bottom line is, this is after yesterday's close now, and I want to make another point. A lot of talk in those articles and a lot of talk on, media and so on about stock has been down 10%, it's down another 2% today. This is what that looks like. Let me go to the forecasting graph here and just point out to you, this little drop in AT&T's value over the last couple of days is really insignificant when you look at it in the perspective of the long term here. It's just normal price volatility, which occurs with a common stock constantly. But the stock is very, very inexpensive, trading at a 9 blended PE, which gives it an earnings yield of almost 11%, even on these really mooted earnings here, and I'll get into that here in a moment. And the current dividend yield prior to this announcement was about 7%. But here's the important point I want to get at. If you look at this from a performance point of view over this time, the dividend only grew about 2% a year. So it was all about a high current yield. From the time I originally purchased it and here I'm measuring it from the end of 2011 to current, on each $10,000 investment that was made, the dividend income would have went from $585.32 up to $687.83. My yield on cost has increased from, the original 5.87, which is what I calculated originally, 5.85 to 6.88. But I got about $5,740 worth of income off of this investment per every $10,000 made. But that was part of an overall investment of portfolio strategy, as I alluded to earlier. At the same time that I invested in AT&T, I also invested in Amgen. Now, I want to make a point. Amgen at the time only had a dividend yield of about 0.87%. So you add AT&T's 5.7-ish with 0.87, you get over 6%. And the combination of the two investments was giving me an income yield of over 3%, which was my target yield for the portfolio. Okay, I wasn't trying, I knew I wasn't going to make a lot of capital appreciation from AT&T. I didn't expect to. Now, fortunately, even at these very low valuations, I've broke even. So from that perspective, you can think of AT&T acting like a bond. But here's the real kicker. If you look at this stock only yielding 1% at the time, if I measure its performance, its dividend has grown for me at over 30% a year. Average growth rate of 36 almost, and a compound average growth of just over 31. So that original dividend was about $224 at the end of the first year, by the way. My yield actually turned out to be about 2.25% after a year. I started out at 0.87, I want to remind you. By last year, I'm up to 9.97, and I get $5,450 of dividends from my $10,000. I got almost as much income out of this low-yield, faster-growing stock as I did from AT&T. But now I've turned my $10,000 into $39,000, add in the dividends, and I've had over a 4-to-1 rate of return. So when I'm looking at this from the perspective of the total portfolio, AT&T was bond-like. It gave me a little bit of increased dividends. I actually would have lost money slightly, just a few, But that, of course, the opera ain't over until the fat lady sings, as the old cliche goes. And the reality of it is, I'm still holding AT&T even today. And I'm probably going to continue to hold AT&T. But what's happened is, what I really want to make a point here is, I don't need the high yield from AT&T as much as because not just Amgen, but other investments that I've made in the portfolio have grown their dividend and their income at a lot higher rate. So my portfolio's income has kept up with inflation. It's actually increased in value. AT&T was like putting part of the money into a bond in my mind's eye. I wasn't trying to make a great deal of money. I was hoping to hold its value. Now, I still think AT&T is worth more than it currently trades at. But here's the other issue now. Now I've got a new dilemma. This is going to take possibly a year before this transaction actually transpires. But I want to remind everybody that's looking at this, you're now going to get a 71% interest. AT&T shareholders are going to get a 71% interest in this new Discovery Time Warner merger that's going to happen here. And, it's expected to generate a lot of free cash flow and a lot of EBITDA, but this will be more of a growth scenario. And Discovery has really, dropped dramatically to the point where it is at more of a capital appreciation investment at this point, meaning that, you'd be investing in Discovery for capital gains, no dividends, obviously. The AT&T portion that you're holding, currently was the income portion. The yield is expected to be somewhere around 3.5% to 5% on this new entity. I don't think that's fully been determined yet. Analysts are speculating, and those are the numbers that they're coming up with. But the point is, if income was still my goal and I was still needed more income, I think I can let a little capital appreciation sit in this portfolio now. But if income was my goal, I can always sell the Discovery at some point. I might hold it a little while it's still undervalued and reinvest it maybe into some more Amgen or put it into Bristol Myers or AbbVie, some of these other stocks that have, very, very attractive dividend yields right now if I was maintaining the integrity. In other words, I have options. I could buy, these other stocks and get higher dividend yields than I'm currently getting and keep my overall income about the same as it was. The Discovery has no dividend income, and this would strictly be capital appreciation. And, AT&T has not surprised me. That's another point I want to make here. AT&T has performed about like I thought it would, and I'm really meaning the white line, the dividend income. I expected very little growth in dividends. I want to look at forecasting here a little bit and just make sure you also understand this. The current estimates for AT&T have dropped. Incidentally, 6 months ago, the analysts were forecasting $3.23. Current estimate was $3.17. Now, this number is going to change with this new big transaction that's been announced because obviously the company's going to change. But the moral of the story is, what were you investing for? I didn't buy AT&T ever with the illusion that I was going to make, 10 times my money. It was going to be a Peter Lynch 10-bagger. I bought it because it provided me an income stream that allowed me to generate enough income on the portfolio that I could live off of that income, or that the people I was buying it for could live off the income, to be more clear. And I needed at least a 3% rate of return. And by buying AT&T and Amgen together, I got that. I ended up making 4-to-1 on my money with Amgen, and I ended up maintaining my investment with AT&T. So you could say I made over 2 times my money from a capital appreciation point of view, but I also kept up with inflation on both income and capital appreciation. So the point is, everything in its place and a place for everything. And just like if you were building a football team or a baseball team or even a corporation, if you were starting a new business, you have different players with different jobs and they have different objectives with their jobs. You have the home run hitter on the baseball team, but you also have the base hitter. You have the fast running back, on your football team, but you also have your offensive linemen and your defensive linemen, your blockers and tacklers, each of them doing a different job. AT&T was built or invested in by me to do a specific job. And frankly, it's done that job. I've never considered it a value trap because I understood exactly what AT&T was all about when I was investing in them. I'm a little disappointed in how the market's treating it, but now we've got this new AT&T, which will be a faster growing entity with a lower yield. Time will tell, what's going to happen. And now I've got many options and many ideas of what I might do, I may keep my AT&T in Discovery. I may keep the AT&T, sell the Discovery and reinvest it in a dividend-paying stock. I may sell both of them and reinvesting in some other opportunity, because you always have options, and that's the key. So at this point, there's a lot going on with the AT&T transaction. The stock has done exactly what I invested in it for. I'm not in the least bit disappointed, because I never believed it was going to be a big capital gain generator. So, that's my take on AT&T. If you want to know more about this transaction, like I said earlier, you can go online here, and there are just, numerous articles. The Wall Street Journal has listed several here, that they've published in their own journal, including the Barron's article that I, highlighted here a moment ago, how much AT&T might be worth. A lot of speculation, a lot of sources where you can find a lot of information. Morningstar, by the way, also has a significant, new write-up on their take on it. They're giving AT&T a fair value that's above what the stock is currently trading at right now. Okay, so that's kind of interesting. You can also go to other sources like Zacks, and, there's just hundreds of sources, Google Finance. You can look at all these different sites here. You're going to see a lot of information available on the AT&T deal. I'm going to let you vet that out yourself if you're interested. What I wanted to do here was provide the idea that AT&T was invested in by yours truly for a specific purpose, and it actually met that purpose beautifully. It did exactly the job that I had invested in it for, and I had no illusions or even delusions that it was going to be anything but that. It's worked out exactly as I planned. So, again, I'm pleased with it. I was able to get more yield by blending it with a faster growing stock. And by the way, I'm using only one other example there. It was actually part of an overall portfolio where there were actually 25 stocks in the portfolio. And it was one that just gave me a little bit of a yield kicker. It has to do with portfolio strategy, which would be part of another video. Anyway, I hope this gave you some insights into AT&T and what's going on and what kind of investment it is. It's never been a growth investment since I've been involved in it. It's been more like a utility or more like a bond. Anyway, this is Chuck Carnevale saying thanks for watching. I hope you found this interesting and of benefit. I appreciate you very much. If you liked the video, give me a like, ring the bell, and subscribe to the channel if you haven't already. Thanks for watching.